So, you want to buy a cruise ship? The biggest cruise ships on Earth don't cost millions. They cost billions. Royal Caribbean's newest Icon-class ships are estimated to cost around $2 billion each, making them some of the most expensive civilian vehicles ever built. That's roughly the price of an aircraft carrier, except yours comes with 6 water slides, 40 restaurants, an ice rink, and 7,000 people asking why the Wi-Fi isn't free. The strange part is that, at the same time, old cruise ships sometimes sell for less than a downtown office building. In 2024, 6 former American Queen Voyages river cruise vessels were sold out of bankruptcy for a combined just $9 million. One of them changed hands for only $2.15 million. In the cruise business, the difference between a billion-dollar flagship and a bargain bin ship isn't measured in luxury. It's measured in whether anyone still wants to sail on it. A cruise ship isn't really a ship. It's a floating hotel that occasionally changes zip code. The first tier is the small expedition or river cruise vessel. These usually carry between 100 and 500 passengers. Older vessels can trade for anywhere from $2 million to $50 million, while a modern purpose-built expedition ship often costs $150 million to $300 million to build. You'll find these operating in Alaska, Antarctica, the Norwegian fjords, or Europe's river systems. They're designed for destinations where giant ships simply can't fit. Step up to the mainstream ocean-going ships. These carry roughly 2,000 to 4,000 passengers and form the backbone of companies like Carnival, Norwegian Cruise Line, and MSC Cruises. A new vessel in this category generally costs somewhere between $500 million and $900 million, depending on capacity and technology. These are the workhorses of the Caribbean, Mediterranean, and Asian cruise markets. Then you reach the megaships. Royal Caribbean's Oasis class changed the economics of cruising by treating the ship itself as the destination. Each vessel cost roughly $1.3 to $1.4 billion to build and carries well over 6,000 guests, plus more than 2,000 crew members. Today's Icon-class ships push construction costs toward $2 billion as shipyards compete to build floating cities instead of transportation. Finally, there's the luxury end of the market. Companies like Ritz-Carlton Yacht Collection, Explora Journeys, and Scenic operate much smaller ships with dramatically higher spending per passenger. They may carry only a few hundred guests, but each cabin resembles a 5-star hotel suite, and construction costs per berth can exceed those of a conventional cruise ship by a wide margin. So what if you actually wanted one? You have 3 choices. The first is commissioning a new ship. Unless you're already running a global cruise line, forget it. Only a handful of shipyards, such as Chantier de l'Atlantique in France, Meyer Werft in Germany, and Fincantieri in Italy, can build modern cruise ships. Their order books stretch years into the future, and you're expected to write checks measured in hundreds of millions before anyone starts cutting steel. The second option is buying a used vessel. This is how most operators expand. Large cruise companies routinely sell older ships as newer ones arrive. An aging Carnival or Norwegian vessel might continue operating for another decade under a regional brand in Asia, the Mediterranean, or South America. A ship that no longer fits one company's luxury standards may still have thousands of profitable voyages left elsewhere. The third, and occasionally cheapest, route is waiting for someone else's disaster. Cruise companies carry enormous debt because ships are extraordinarily expensive. When demand disappears, lenders eventually become the owners. That's exactly what happened after the pandemic and in several bankruptcy cases. In 2024, American Queen Voyages collapsed, and its 6-ship fleet was auctioned through bankruptcy proceedings. American Cruise Lines acquired the flagship American Queen for $2.15 million, while the entire fleet sold for only $9 million combined. That's less than the price of many waterfront mansions. Of course, the purchase price is only your admission ticket. The day after you buy the ship, the meter starts running. Why would anyone voluntarily buy one of these things? Because a cruise ship is a temporary monopoly. For a week, somewhere between 2,000 and 8,000 people are trapped inside a floating city with very limited alternatives. Every drink, every specialty meal, every casino chip, every shore excursion, every photograph, every internet package, and occasionally every bottle of sunscreen flows through you. That's the economic logic. You're not selling transportation. You're controlling an entire consumer ecosystem for several days at a time. And sophisticated buyers understand that. During the industry's expansion years, cruise assets attracted financing from major banks, institutional investors, sovereign wealth funds, export credit agencies, and private equity-backed operators. The ships themselves became infrastructure-like assets attached to tourism demand rather than simple hospitality businesses. The key question isn't whether people want cruises. It's whether they want your cruise, because once they're on board, the economics become very interesting. The obvious revenue stream is ticket sales. The global cruise industry generated roughly $40 billion plus in annual passenger ticket revenue in the years following the industry's post-pandemic recovery. Every occupied cabin represents a combination of accommodation, food, transportation, and entertainment bundled into a single purchase. But tickets aren't where the really interesting money lives. The second stream is onboard spending, bars, casinos, specialty restaurants, spa treatments, internet packages, photographs, premium experiences. Major cruise operators routinely report billions of dollars annually from onboard and ancillary spending. Industry analysts often note that some passengers spend hundreds of dollars beyond their original fare before they ever return to port. That's when you realize something slightly strange. The advertised cruise fare often functions like the cheap printer. The ink cartridges are where the margins start showing up. Then there are shore excursions. Every port stop creates another sales opportunity. Snorkeling tours in Cozumel, glacier flights in Alaska, wine tours in Italy, private island experiences in the Caribbean. The global excursion business generates billions of dollars annually across the industry, and cruise lines increasingly prefer owning or controlling parts of the experience themselves rather than merely collecting commissions. Royal Caribbean's Perfect Day at Coco Cay is perhaps the clearest example. The destination itself became part of the revenue model. Even the beach is vertically integrated. Then there are casinos. Not every passenger gambles, but enough do. Once a ship reaches international waters, onboard casinos become major profit centers. For some vessels, casino operations contribute disproportionately to onboard profitability compared with the physical space they occupy. A few thousand square feet can generate revenue comparable to facilities many times larger, which sounds wonderful until you discover what it costs to keep the lights on. A cruise ship burns money before it earns money. Crew is usually the largest controllable operating expense. A modern large cruise ship may carry between 1,000 and 2,500 crew members. Salaries vary enormously depending on position, nationality, and contract structure. But total crew costs for a major vessel can easily reach tens of millions of dollars annually. Every day the ship sails, thousands of people need to be paid, whether passengers show up or not. Then comes fuel. A large cruise ship can consume well over 100 tons of fuel per day depending on speed, size, and itinerary. Fuel markets move constantly. which means profitability can change simply because energy prices moved in the wrong direction halfway around the world. A ship making money at one oil price can become dramatically less attractive at another. Then you have maintenance. Ships live in salt water. Salt water hates ships, paint, engines, propellers, air conditioning systems, water treatment systems, elevators, cabins, safety systems. Every component is slowly trying to die. Periodic dry docking can cost millions or tens of millions of dollars depending on the work required. Classification societies, regulators, and insurers are remarkably uninterested in excuses. The ship passes inspection, or the ship doesn't sail. Insurance is another line item capable of ruining your mood. You're operating a floating city carrying thousands of people through multiple jurisdictions, international waters, severe weather, and occasionally geopolitical uncertainty. Insurers charge accordingly, and then there's compliance. Environmental regulations continue tightening across Europe, North America, and parts of Asia. New emissions requirements, cleaner fuels, wastewater standards, and port restrictions all require capital spending. The ship you buy today may require expensive upgrades tomorrow just to keep operating. If that sounds manageable, consider 2020. COVID-19 effectively stopped global cruising. Revenue collapsed. The ships didn't. Thousands of vessels remained afloat, requiring maintenance, security, insurance, debt payments, and minimum staffing even while carrying few or no paying passengers. The industry's largest operators collectively lost billions. Ships were anchored, bills were not. Some vessels were sold. Others were scrapped years earlier than planned. Entire business models were stress-tested by a virus. And the lesson was brutal. A cruise ship without passengers isn't a dormant asset. It's an actively expensive problem, which raises an uncomfortable question. If the official business is transporting vacationers across oceans, what are the less obvious ways money gets made? That's where things start getting interesting. Most people think a cruise ship earns money from cruises. That's true. It's also incomplete. Because one of the stranger realities of the cruise industry is that many of the world's largest operators aren't really based where most of their customers live. Take Carnival Corporation, Royal Caribbean Group, and Norwegian Cruise Line Holdings. Their passengers are overwhelmingly North American. Their ships sail all over the world, but their corporate structures have long been tied to jurisdictions such as Panama, Liberia, and Bermuda. The reason is simple: taxes, labor rules, regulatory flexibility. International shipping has spent decades building legal structures that allow operators to choose where a vessel is registered rather than where its customers live. A cruise ship can effectively shop for legal jurisdictions the way a multinational corporation shops for tax rates. The industry calls it a flag of convenience. Critics call it something less polite. Either way, it changes the economics dramatically. Then there are repositioning cruises. Most passengers never think about them. Ships don't magically appear in Alaska every summer and the Caribbean every winter. They have to move. Cruise lines discovered that customers would actually pay for these long one-way voyages, turning what would otherwise be a logistical cost into a revenue-generating product. You get a vacation. The company gets paid to move inventory. Everyone pretends this was the plan all along, and occasionally the hidden economy gets stranger. In 2024, regulators continued scrutinizing environmental claims across the cruise industry as operators promoted cleaner fuels and sustainability initiatives while simultaneously expanding capacity. The debate isn't merely environmental. It's financial. Every new emissions rule potentially shifts billions of dollars in future retrofit costs across global fleets, which brings us to the part where things go wrong. Because eventually, in every capital-intensive industry, somebody makes a very expensive mistake. Let's start with American Queen Voyages. In February 2024, the river cruise operator abruptly ceased operations and entered bankruptcy. Its fleet, which had once represented a premium niche in U.S. river cruising, was eventually auctioned off. The entire six-ship fleet sold for about $9 million combined. The lesson? A cruise ship without enough paying passengers isn't an asset. It's a depreciating liability with engines. Then there's Genting Hong Kong. For years, the company operated Star Cruises, Dream Cruises, and Crystal Cruises, while also investing heavily in shipbuilding infrastructure. In 2022, the company entered liquidation, with liabilities exceeding $3 billion after pandemic disruptions devastated cash flow. Ships were arrested by creditors, operations collapsed, luxury brands disappeared almost overnight. The lesson? Leverage works brilliantly right up until revenue vanishes, and then there's the incident everyone remembers, the Costa Concordia disaster. On January 13, 2012, the Costa Concordia struck rocks off the coast of Italy and partially capsized. 32 people died. The eventual financial cost ran into billions of dollars when salvage operations, compensation, legal costs, and reputational damage were added together. The wreck removal alone became one of the most expensive maritime salvage projects ever attempted. The lesson? In a business built on public confidence, reputation can disappear faster than steel sinks. Then there's the geopolitical risk. Cruise routes depend on stability. A war, a regional conflict, a sanctions regime, a port closure, or a security incident can instantly rewrite itineraries planned years in advance. Over the last year, shipping companies across multiple sectors have faced disruptions linked to attacks in and around the Red Sea region, forcing route changes, increasing insurance costs, and reminding operators that oceans are not politically neutral spaces. A cruise ship's destination list is only valuable if people can safely reach those destinations. Which brings us to the final question. What does ownership actually look like on paper? Imagine you buy an older small river cruise vessel for $5 million. Let's say it generates $3 million in annual revenue. Crew, maintenance, insurance, fuel, marketing, and financing consume roughly $2.8 million. You make about $200,000. Maybe, assuming nothing breaks. You're not really buying cash flow. You're buying optionality and hoping demand grows. Now imagine a mid-sized ocean-going vessel acquired for $150 million on the secondary market. Suppose annual revenue reaches $90 million. Operating costs absorb $75 million. That leaves $15 million before financing costs, taxes, and capital expenditures. A respectable business, not a magical one. Finally, imagine a modern megaship costing $1.5 billion to $2 billion. A successful vessel can generate several $100 million annually in revenue. But it also requires enormous staffing, fuel consumption, maintenance budgets, debt servicing, marketing expenditure, and periodic upgrades. A single bad year can erase a lot of good years. The numbers become spectacular. So do the risks. And that's the strange thing about buying a cruise ship. At first glance, you're purchasing a giant vessel. Then you discover you're actually buying a hotel. Then you discover you're buying a casino. Then a restaurant chain. Then an entertainment company, then a transportation network, then a highly leveraged global logistics operation floating in salt water. A cruise ship is not a ship. It's a temporary monopoly on thousands of people's wallets while they're too far from shore to spend money anywhere else.